Silver investors, we just entered a world where silver has two prices, and the gap between them is big enough to break trust in the whole system. In the West, silver is trading in the high 80s, looking calm, boring, under control. In Shanghai, the world's biggest physical hub, the same metal just traded over $100 an ounce, with regulators suspending accounts and the main Western futures exchange sitting on only 88 million ounces of registered supply. OG John AG here. No courses, no signals, no VIP groups, just numbers you can verify, sources you can pull up yourself, and a breakdown of what those numbers really mean for your money. In this video, I'll show you why Shanghai is paying triple-digit prices while New York pretends $88 is fair value, how 23 trading accounts just got frozen in China, and why COMEX inventory is collapsing toward 88 million ounces is not a coincidence, and why the next 72 hours into First Notice Day could decide whether paper silver stays a game or gets exposed as a promise too big for the metal behind it. This isn't theory. This is a live stress test. Segment 1. 2 silver prices, 1 planet. Let's start with today's tape, not a 10-year macro story. In Western markets, spot silver opened around $88 per ounce, trading roughly between 84.65 and 88, down about 1% on the day, the kind of move that never even gets a breaking news banner. Now jump 9,000 kilometers to Shanghai. The Shanghai Futures Exchange had been shut for 9 days for Lunar New Year, the longest annual pause in the biggest physical commodity venue on Earth. When they flipped the lights back on, silver didn't calmly resync with New York at $88. It launched to about 22,634 yuan per kilo, which at today's exchange rate works out to roughly $102 per ounce. Same day, same metal, same planet, but roughly a 16% premium in Shanghai. If you're holding physical silver in China, the market just told you your ounces are worth around $102. If you're holding a futures contract in New York, the system is telling you your paper claim is worth around $88. That $14 gap is not a rounding error, not a glitch. It's a structural warning about physical supply. Segment 2. This is a silver problem, not a generic metals move. Shanghai's premium didn't appear out of nowhere this morning. Before the holiday, silver in Shanghai was already trading at about an 11% premium, and physical buyback prices in Shenzhen were pushing close to 95 per ounce. Look at the last 6 months. Average Shanghai premium about 6.6%. Peak during the January crash, around 34%. Now compare that to gold. Shanghai gold premium right now is roughly 0.29%, basically flat. Silver's premium is almost 38 times bigger than gold's. That tells you this isn't Asia loves metal in general. This is a silver-specific physical squeeze. Gold is trading like a normal global market. Silver is trading like a market with a hidden problem no one wants to talk about on TV. Segment 3. China quietly weaponized silver. Why is China willing to pay that much more for the same metal? 3 structural moves. First, on 1st January 2026, Beijing officially reclassified silver as a strategic material and slapped strict export licensing on it. Only 44 companies got permission to export silver for the 2026-27 cycle, and each one has to prove at least 80 tons per year of capacity. At the same time, China controls something like 65% of global silver refining capacity. When the country that refines roughly 2/3 of the world's silver says, "We will decide how much leaves," you create a bottleneck no amount of hedge fund paper trading can magically fix. Second, China's domestic industrial demand is a monster. They are the world's biggest producer of solar panels and also the biggest consumer of the silver those panels require. Add electronics, EVs, grids, and infrastructure, and the message becomes clear. First, we feed our factories. Then, if anything's left, we'll think about exports. Third, you have capital controls, import quotas from the PBOC, and a 13% VAT on silver that all work together to block clean arbitrage. During the January crash, once you included VAT, the effective premium blew out to around 45.8%, roughly a $34 per ounce theoretical arbitrage, and still nobody could close it because the pipelines are politically controlled. So Shanghai's 100+ price isn't just emotion, it's the real-world cost of metal in a system that decided silver is strategic and not everyone deserves equal access. Segment 4, 23 accounts suspended, the quiet warning shot. Now to the headline most people will never read. Today, the Shanghai Futures Exchange issued notice number 46, dated 24 February 2026. In that document, they confirm they've suspended another cluster of accounts for violating their rules on abnormal trading behavior, specifically going over intraday position opening limits in silver contracts. The punishment, hard limits on how many new positions those accounts are allowed to open. And this is not a one-off, it's part of a trend. 5 February, notice 37, 6 linked account groups suspended, 26 to 27 January, another 34 clients restricted. In January alone, 125 abnormal behaviors logged, including 38 intraday opening volume breaches and 39 clusters of related accounts. Add up just February, and you're now at roughly 23 accounts suspended or restricted. In precious metal circles, there are reports that some of these accounts may tie back to Western banks, with JP Morgan's name popping up in alternative media and in a recent disruption banking piece about a huge short allegedly closed at the very bottom of the crash. But here's the line. The exchange itself does not publish names. That link is alleged, not confirmed by Shanghai. What is confirmed is this pattern. Shanghai is now actively hunting and throttling large, aggressive silver trades, especially those that smell like they could distort price to the downside, and they did it on the same day silver printed over $100 there. That timing is not random. Segment 5, meanwhile in New York, 88 million ounces left. While China is tightening the screws, COMEX in New York is dealing with a slow-motion inventory crisis. Registered silver, the metal actually tagged and available for delivery against futures, has dropped to around 88.2 million ounces as of 22 February. Back in October 2025, that number was about 167.7 million ounces. So in roughly 4 months, almost half of the deliverable inventory has left COMEX vaults. The pace is speeding up. Between 12th through 18 February, around 14.07 million ounces walked out of registered. That's a 13.8% drop in 1 week. Over the last 30 days, net outflow is roughly 54.9 million ounces, with about 3.7 million coming in and 58.5 million going out. On 18th of February alone, HSBC lost about 641,000 ounces, and Brinks lost around 596,000 ounces from their registered stocks. Yes, JP Morgan still shows about 12 million ounces registered and around 143.85 million ounces eligible, by far the largest eligible pile. But eligible belongs to specific owners and can't just be grabbed and forced into delivery without their consent. So the headline number that matters for futures promises is that 88 million ounce pile, and it's shrinking. Segment 6, March contract, more claims than metal. Now overlay that inventory with the March 2026 silver contract, the main delivery month. Open interest on March is around 43,971 contracts, each representing 5,000 ounces, for a total of about 219.9 million ounces of paper claims. Compare that to the 88.2 million registered ounces on COMEX. You have roughly 2.5 times more paper silver promised than metal actually sitting in the ready-to-deliver bucket. One respected data tracker, Heavy Metal Stats, has the coverage ratio at about 3.8x and tags the status as stress. In practical terms, their musical chairs ratio works out to something like 8 claimants for every registered ounce. Now circle this date on your mental calendar, February 27th, first notice day for March. Any long holder who doesn't roll or close by then has the right to stand for physical delivery. If even a modest chunk of those contracts decide, nah, I don't want cash, I want the metal, the math goes upside down fast. 88 million ounces of registered metal versus roughly 220 million ounces worth of potential delivery requests. That doesn't guarantee an explosion, but it does mean the system will have to get creative if too many players say, deliver. Segment 7, derivatives plumbing, calm price, screaming options. Now look at the option side, where fear gets priced before headlines. On SLV, implied volatility around 99 to 103% annualized versus about 37% realized over 12 months means options are pricing almost 3 times the movement that spot has actually shown. At roughly 103% IV, the implied one-day standard deviation sits near 7.3%, and a 3 sigma move means something like a 22% single-day swing or about a $19 move from current levels. Yet for more than a week, silver has been stuck in a narrow 80 to 88 range. So the options market is effectively yelling, this calm is not real, something big is coming. The spot market is still pretending everything is fine. Historically, when that kind of gap opens up between implied and realized, one of them is wrong, and the resolution usually comes fast and hard. Add in the exchange for physical, EFP, spread blowing out to around $1.10 versus a more normal $0.25. Silver lease rates spiking as high as 35% per year at the peak of stress. Margin requirements on COMEX raised to about 60% of notional, a level only seen in major past crises like the Hunt Brothers episode and the 2011 top. Every small pipe in the plumbing is flashing red, while the screen price pretends nothing's happening. Segment 8, gold, miners, and the macro backdrop. Put this inside the bigger precious metals picture. Gold today has been trading in roughly the $2,168 to $2,282 zone, down about 1.5% from Monday's close near $2,206 after hitting a 3-week high around $2,250. The gold-silver ratio sits near 58.7, way off the 100.1 extreme from April 2025. That compression means silver has already been outperforming gold, which usually happens during the acceleration leg of a metals bull run. Macro backdrop, core PCE inflation stuck near 3%, while Q4 GDP limps along around 1.4%, classic stagflation. The Fed holding rates in the 3.5 to 3.75% range, but deeply split internally on how long they can keep that up without breaking something. The dollar index sliding under 97.5, down roughly 8.5% in a year. Big banks are quietly repositioning, UBS targeting around $6,200 gold by mid-2026, Wells Fargo talking $6,300. Bank of America's silver target in the high 30s, Citigroup floating $150 as a longer-term possibility. These are not YouTube thumbnails. These are major institutions publishing numbers that imply we are not near the final top if their models are right. Meanwhile, primary silver miners are printing insane margins, producing at roughly $11–14 all-in sustaining cost, with spot near the high 80s, yet many analyst models still assume long-term silver at $25 to $50. That gap between reality and spreadsheet is a powder keg for mining stocks once Wall Street updates its inputs. Segment 9. The bear case. How this doesn't turn into a moonshot, yet. This channel style is about math, not hopium, so let's be blunt about the downside. Shanghai just reopened after 9 days offline. Some of today's move is catch-up, and part of that huge premium can compress as the two markets resync. COMEX has tools. They can shift metal from eligible to registered in 24–48 hours, extend delivery windows, encourage cash settlement, or quietly source metal elsewhere. We've seen this movie before. January's crash from $121 to $64 in about 30 hours proved that 100% vol cuts both ways. If we get a real global recession, industrial demand, solar, electronics, EVs, will take a hit, and for a while that can overpower the supply deficit story. Those big bank targets, $39, $150, are based on long horizon math. Being right about direction and wrong on timing is how people with the correct thesis still blow up. So anyone telling you silver can only go up from here is either naive or selling something this channel style doesn't sell. Segment 10. What this setup really means for you. Put the pieces together. We now have Shanghai pricing physical silver above $100 while New York prices paper silver around $88. A Chinese exchange actively suspending accounts and tightening intraday limits in response to aggressive trading, with 23 accounts hit this month alone. COMEX registered inventories sliding 47% in 4 months to about 88 million ounces, with March open interest representing more than twice that amount. Options, EFP spreads, lease rates, and margins all signaling stress, even as the spot chart looks deceptively calm. Miners making record cash, central banks quietly shifting reserves toward gold, and the dollar's share of global reserves falling to multi-decade lows. This isn't a prediction video, it's a setup video. The real question isn't, will silver tick up or down tomorrow? It's, can a market where 220 million ounces of paper claims are stacked on top of 88 million ounces of readily deliverable metal keep pretending that everything is fine, especially when another superpower is openly paying triple-digit prices for physical? Over the next 72 hours into first notice day, we'll get a partial answer. If stress gets flushed with cash settlements and quiet deals, the system survives, but confidence erodes a little more. If something breaks in public, we stop talking about silver as a boring commodity and start talking about it as a case study in financial engineering hitting a hard physical limit. You don't have to time the exact minute. Your edge is understanding why this spread, these inventories, and these enforcement moves matter before the headline writers catch up. If this breakdown helped you see the difference between paper claims and real metal, like the video so this kind of content doesn't get buried, hit subscribe, turn on all notifications, and drop a comment. 2 prices, 1 metal, and tell me what you think happens first. The Shanghai premium collapses, or COMEX finally admits it doesn't have enough easy ounces to satisfy everyone who shows up with a claim.